Good afternoon, everyone. A warm welcome to everyone for today's live webinar on intricacies in reopening of assessments. Our speaker for today is Advocate Dharan Gandhiji. The reopening of assessment, the topic itself, is a multifaceted process with significant implications for both taxpayers and tax authorities. By delving into the intricacies of this subject, our seminar endeavors to equip participants with knowledge and insight necessary to navigate assessment challenges effectively, ensuring compliances with regulatory requirements while safeguarding taxpayers' rights. Before I request Advocate Dharan Gandhiji to start his deliberation, I would like to welcome and give brief introduction of our ICAI Direct Tax Committee Chairman CA Piyush Chhajarji and Vice Chairman CA Kota Srinivasji. CA Piyush Chhajarji is a practicing chartered accountant for last 20 years. He specializes in direct tax and indirect tax, appellate proceedings, and arbitration proceedings. He is a speaker on various topics of direct tax, a member of External Committee of Reserve Bank of India Asset Reconstruction Committee, a vital contributor to WIRC publication on Vivad Se Vishwas scheme, and he is also practicing litigation in direct as well as indirect tax. Our Vice Chairman, CA Kota Srinivasji, he is a fellow member of the Institute of Chartered Accountants of India and also a member of Institute of Cost and Works Accountants of India. He has served the institute for over 2 decades on various positions like as managing committee members, regional council members of SIRC of ICAI. CA Kota Srinivasji, as a member of SIRC, has brought in many initiatives which includes conducting ARRC, that is annual regional residential course on international taxation. He prepared concept papers on coaching classes as a chairman of academic advisory group. And these are very few of many others initiatives that he has done in last 2 decades. Now, I would like to introduce our speaker for today, Advocate Dharan Gandhiji. Advocate Dharan Gandhiji practices as an advocate before the Honorable Supreme Court, Honorable Bombay High Court, and other high courts, Income Tax Appellate Tribunal, CIT Appeals, and DRP, and specializes in corporate tax, international tax, transfer pricing, and GST litigations. He was part of team representing Chamber of Tax Consultants in petitions challenging ICDS before the Honorable Delhi High Court and in petition challenging CBDT Central Action Plan giving incentives to CIT appeals before the Honorable Bombay High Court. He was the chairman of Commercial and Allied Law Committee of Chamber of Tax Consultants for the year 2020-21. He was a member of Direct Tax Committee of the WIRC of ICAI for the year 2019-2020 and conveyor of the Direct Tax Committee of the Chamber of Tax Consultants for the year 2017-18 till 2019-20. He is a regular contributor in the professional journals and publications and also a regular speaker on various issues of direct tax. He is a co-author in various books, few like a treatise on Vivad Se Vishwas Act 2020 in FAQ format, interpretation of statutes, FAQs. He has presented papers on various RRCs and conferences. He was also a paper writer at National Tax Conference 2019, organized by All India Federation of Tax Practitioner Association. On academic front, he has scored 7th rank on All India basis in CA final examination and 30th rank on All India basis in CA PCC examination. Further, he has a unique distinction of scoring 100 out of 100 in accounts at CA PCC examination, a kind of dream for every CA students, I believe so. I again welcome everyone. Now I request CA Piyush Chhajarji give his welcome address.
Thank you very much. A very good evening to all of you. Thank you, Sachin Verma, CA Sachin Verma ji, for your introduction to us. I'm joined by, on my right hand side, my Vice Chairman of Direct Tax Committee of the Institute of Chartered Accountants, CA Kota Srinivas. Faculty for today, CA Advocate Dharan Gandhi. He has written advocate, but we know him as a chartered accountant more because he is a member of our institute. SP Singh Saab, CA Prachi Jain, the member of Direct Tax Committee, Priyaji, our Secretary of Direct Tax Committee. A very warm welcome to all the participants. Good evening over here. My special request to all the members today, before I start, this is a very important topic today. And the speaker which we have, Mr. Dharan Gandhi, is the master when it comes to reopening. I know yesterday itself he has delivered a lecture on the platform of Chamber of Tax Consultants on intricacies of reopening. And I'm sure, please be attentive for this next 2 hours. And you will come to know such a valuable insight into the intricacies which are involved in reopening, which we would have not thought of. It may look very simple. The new provisions of 148 capital A may look very simple. The procedure laid down may look very simple, but I am sure something will come out when Dharan speaks about it. When he discusses judicial judgments which have come, he's also representing various batch of appeals before the Supreme Court on this. So he's well aware what is the current status of all those, and I am sure this would be very insightful. So my request would be, please be attentive for next 2 hours. And now it's a flavor of season. Generally, the March month, because the time barring reassessments, which is 3 years or 10 years, wherever the reopening could be possible, generally you would find notices coming up in the month of the March. And then you would be issued a show cause notice, you would be required to respond to it. And therefore, I'm sure today's session will help you in effectively discharging your duties towards your clients and responding to them, bringing out the legal position. So it would be a very helpful. Now, coming to a direct tax committee, as you all know, all the participants, if you have not been attending, every Thursday, 4 to 6, we are actually conducting such seminars. And because direct tax committee is now merged, that is in institute 1 year before, we had two separate committees. One is direct tax committee and international tax committee. It's a merged committee. So what generally we do is one Thursday we cover a topic of interest in relation to direct taxes, and one Thursday we try to cover up on international taxation. Likewise, next Thursday, that is on 28th, one of another speaker in the international taxation will be speaking on interpretation of DTAA. And so that's how it is, how we try to cover up the topics. The idea behind such webinars is to disseminate the knowledge, to update the members about the current precedents, judicial decisions, judgments which are coming in the various subjects of the income tax. Coming to direct tax committee, again, very importantly, I'll just touch upon two important things which are very relevant in today's time and would be relevant for the next action plan for the next 3 to 4 months. As you might be aware, we have been discussing on applicability of Section 43 capital B subclause H, and our committee of direct tax committee have already decided in the last month only. They had authorized chairman and vice chairman to come out with an publication. So we have decided that we would be coming with an implementation guide. Of course, there is a guidance note on the tax audit. There are other revisions which are happening in Form 3CD. We could have come with a supplemental guidance note, but as far as process of guidance note is concerned, which requires exposure draft, then approved by the committee, then you go to the council, which takes generally 3 to 4 months. So initially, we are planning that we should come with an implementation guide, which will help the members in discharging their assurance functions whenever they are certified Form 3CD. So that implementation guide will also cover the amendments which have been recently made. Last week, I believe, in the Form 3CD, certain apart from 43B subclause H, which has been inserted, there are certain other amendments we'll try to cover. I request to the members would be, please look into that. Please try to adopt that. Please try to follow the procedures or the guidelines which are given into that. That will help you in ring fencing when you are put to a question. If your assurance functions have been put to the question as a chartered accountant, that how you have dealt with it. If you are able to prove that yes, I've done what has been given in implementation guide or what has been given in the guidance, so it helps you in ring fencing against the questions which may put before you towards your assurance function. So please look into that. Similarly, as last year we came up with a technical guide on 10B and 10BB, that is audit of charitable institutions. We are trying to convert that into a guidance note. So it will be at higher pedestal when we talk about the publications issued by ICI. Guidance note is comparatively at higher pedestal as far as authority is concerned to those publications compared to the technical guide or an implementation guide. And they are sort of a mandatory, whereby if you are not complying with that, then you have to document the audit procedures, why you have departed from the guidance note. So if you have not done the procedure which is given in the guidance note, you have to please make a mention of it, or you have to document it, that what are the alternate audit procedures you have followed. So my request to all the participants and the membership at large would be that please do follow with the what is stated in the guidance note. Please follow those audit procedures. It would be quite helpful to you. Thirdly, we had a meeting with the CBDT chairman on 6th of March. and with the policy team also. We'll be presenting a pre-budget memorandum. Pre-budget memorandum draft has been already prepared and it was also discussed at the committee level. My request to all the participants and the members, faculties over here, Dharanbhai, Sachinji, that if you have any suggestions or any amendments of the section, or you would think of bringing in something new ideas, I'm sure we can make include that in pre-budget memorandum, and we hope to present this pre-budget memorandum somewhere in first week or second week of the April, after seeking time from CBTT, and they've said that we'll give you a time, maybe 2 hours, 3 hours, to present whatever amendments has been said. Whenever you are making, if you have any suggestions, please do write to Direct Tax Committee, that is at dtc@ici.in. My only request, when you are writing, please also, while suggesting or while making any suggestions on an amendment in the act or in the rules or regulations, please give a short note on what is the rationale behind it, what has been sought to be achieved, what is the justification. So it becomes easier for us at the committee level to compile that and also take it forward to the CBDT. I'm sure they will have a open ears to it. And generally, CBDT have an open ears to Institute of Chartered Accountants whenever we make a pre-budget memorandum or we make any representations. Quite on and often, we are making a representation. The 43B subclause H, in fact, we were representing that Form 3CD should be amended to include that. Then on the auditors would be able to comment upon it. Otherwise, it will be left open for the assessee to take a call when the computation has been made. And there won't be any auditor's role per se. So they are open to suggestions, open to representations. Whenever some issues come up in relation to mismatch on CPC or whatever it is, we keep on making short representations, and CBDT do look into it and also consider it very positively. In fact, as a positive step in that meeting, they also said on a quarterly basis we can have such meetings. So we are planning to have a quarterly meetings with the policy making, wherein issues in relation to issues faced by the SSE or maybe by the professions, which have been escalated to Direct Tax Committee, we may compile them and we may have a one-to-one discussion. See, making what we felt is making a written representation and actually going there and explaining them, there's a difference. Written representations may not be taken seriously, but in this quarterly meetings, if we are able to present our case, what are the difficulties faced by the SSE or the practitioners or the public at large, I'm sure they will take it more positively. So with this, obviously, I'll not eat much more time because my vice chairman also has to address it. We have to hear today reopening of assessment, obviously from the master, that is Dharanbhai Gandhi. I am hearing him every day when he argues the matter before ITAT, because I only go up to ITAT. I do not get chance as only being a chartered accountant, not an advocate. I could not hear you in High Court or Supreme Court. I could not get a chance. But obviously, I'm listening to him in ITAT when he argues on 148A matters. I'm sure it would be very insightful. So thank you very much. I would now my request to my vice chairman, Kota Srinivasji, to kindly address it before again we go back to Sachin Verma.
Thank you, Chairman. After the opening remarks of Chairman, now it is reopening remarks of the Vice Chairman. Because today we are talking about reopening of assessment. As when once we file a return, we get a notice from the Department of Assessment. Definitely, it will be a pain point for any professionals or a client. And in this era of faceless assessment, there's a challenge to go and appear before or what I should say, represent before the department virtually, not physically as such. But after the assessment is over, again you'll get another notice of reopening of assessment. It's much more pain points for all the assessees and also the chartered accountants who will be doing it. I hope today the speaker will. Dharal Gandhi sir will CA and advocate Dharal Gandhi sir with his wide experience and exposure. He will definitely take us through how to face these particular challenges or how to appear before the department, so that all of us will get a full insight of these particular provisions and also how to attend these notices when once we receive such notices as such. Coming to the DTC, of course, the chairman has explained detailed, maybe one or two points which I would like to add because I don't want to reopen the opening remarks. So a few things I would like to add is like we also planning to do some of the ARRCs, like the regional residential courses on direct taxes and also on international taxation. Maybe Sachin, when once he was reading my profile, he was saying that when I was in the regional council, I had conducted almost 5 to 9 regional residential courses, 5 on international taxation, 4 on other topics. This year, we are also planning to have regional residential courses on direct taxes, international taxation. Maybe we request all the resource persons to help us out and come and address the members and a small gathering of members. And also, we are planning to have one very detailed workshop. It's called as RITA, that is Revisit Income Tax Act 1961. It's an around 84 hours to 90 hours CP program that also members can get in touch with their respective branches or regional councils, and also the DTC. We will share you the entire structure of the particular program. So if we can try to cover almost section 1 to section 298 of the Income Tax Act. So as the chairman said, every week we are coming before you with some topics, new speakers, new coordinators. I wish that all of us will be benefited by listening to these speakers. I wish a happy learning for the next 2 hours. Thank you.
So now I request Advocate Dharan Gandhi ji to start with his deliberation. Thank you so much.
Yes. CA Piyush Chajad ji, CA Kota Srinivas ji, thank you for having me here and to share my thoughts the reassessment provision. So it's very kind of Piyush ji to call me last week and requesting me to take this topic, and I couldn't say no to him. The fellow chartered accountant who appears regularly in tribunal, and we meet and we generally cross our, in the tribunal only. Nice to see Mr. Verma, who is moderating today's session. Mr. Singh, I recognize the presence of Mr. Singh. CA Prachi Jain, who is a member of Direct Tax Committee. Thank you for giving me opportunity to deal with the, as what Piyush ji said, flavor of the season is the reassessment provisions. So I'll just share my screen. Yeah, is it visible? Yes, thank you. Thank you so much. So I'll just start. Reassessment under the Income Tax Act, just to give a brief background. Under the Income Tax Act, we have a concept of self-assessment. That is, you have to compute your own tax, estimate your own income, pay your advance tax, file your return of income, show your return of income, and pay self-assessment tax. Then there are various schemes of assessments under the Income Tax Act. We have a summary assessment under 143(1), which now no longer remains a summary assessment because we see number of adjustments being made by CPC, and CPC means the computer. We have scrutiny assessment under 143(3), 144. We have reassessment under 147. And we used to have search assessment under 153A, which now has got merged with the 147 provisions. You have revision of assessments under 263 and 264, as well as you have a rectification under 154. The scope of it is very limited. At the end of the day, we have the Supreme Court judgment in case of Parshuram Pottery, which makes things very clear that we have to bear in mind that policy of law is there must be a point of finality on all legal proceedings, and that stale issue should not be reactivated beyond a particular stay. That lapse of time must induce repose and set at rest judicial and quasi-judicial controversies, as it must in other spheres of human activity. So, this words of wisdom by the Honorable Supreme Court way back, which relates to 106 ITR, states that just because an income escaping assessment there's no need to reopen the assessment at each and every point of time. If otherwise it is barred by limitation, you can't please reopen, put an end to it, and that is the end of the matter. Now we have seen these days the number of scrutiny assessments have gone down. The government is now information driven, is what our Honorable Finance Minister had said in the budget. And she's continuously insisting that we are now information driven. We are getting information from various sources. We're trying to link the information. We'll provide you the information before you file return of income. We'll provide you the information after you file return of income. And if there's something missing, you can file either a revised return or an updated return. And the information is getting shared on all-India basis pursuant to search or survey proceedings. So what I'm trying to insist is now the department is moving from a traditional mechanism to an information-driven mechanism. And therefore, the need to come out with the new reassessment regime with effect from 1/4/21. My personal belief is the reopening of assessment, as everybody is aware, can be done within 3 years without any conditions except for 148, 148A, etc. and beyond 3 years up to 10 years, subject to fulfillment of a threshold of 50 lakhs and the other conditions of 149 1B. The reassessment within 3 years appears to be the new scrutiny assessment provisions. So now I personally believe that they'll reopen within 3 years in number of cases, and then they'll do a normal scrutiny assessment, which therefore happens to be a proper scrutiny assessment. And therefore, under guise of reducing the time limit from 6 to 3 years, actually what they have done is they have increased the time limit from 1 to 3 years for scrutiny assessment. And at the same time, under the guise of reducing the time limit from 6 to 3 years, they have actually increased the time limit to reopen the assessment from 6 to 10 years. And even the 10 years condition, they have substantially diluted the conditions as compared to what used to be there when the section was newly brought into the statute book. Now I'll take through the entire sections 147, 148, 148A, 149, 151, 151A. And we'll deal with each of the controversies which I think is relevant. Of course, the time is not sufficient to deal with all the controversies. So let us see what important things we can cover today. At this stage, it is also important to note that prior to 1421, you also had this reassessment provisions. You also had search related assessments under 153A to 153C. Naturally, there were many controversies in 153A to 153C, and therefore, it was getting technically difficult for the government to overcome the technical argument. And as a result, there was a great amount of revenue loss. For example, very recently, everybody is aware the Supreme Court has come out with this judgment in case of Abhisar Bildwell, where the Supreme Court has held that if there is no incriminating material found, and if it is an unabated assessment here, then you can't make an addition under section 153A or 153C, for which purpose you can reopen. As a result of all these controversies, the legislature thought it fit that we should not have separate scheme of assessments for a search related assessment and a normal reassessment. Let us club everything and we can have this one set of provisions for all reassessments. And therefore, the first point which I am trying to highlight is, even pursuant to search after 1421, the department will reopen your assessments only under section 147, 140 and all these provisions, and there is no separate scheme or separate code for reopening of the assessment pursuant to search. With this, we will start with the provisions of section 147 of the Income Tax Act. In my presentation, you will find that there are certain things marked in red, which indicates that they were amendments by Finance Act 2022. And there are certain things marked in golden, which are the amendments carried out by Finance Act 2023. Also, it will be helpful if you have this section in front of you so that you can read and you can understand what controversies I am trying to raise. And lastly, before opening section 147, to understand what are the new points in a section, what one has to do, what I have done is, one has to compare the new section 147 with the old section 147. And that is how you come to know what was there in the old law, which is now no longer there. What was there in the old law, which still continues in the new law. And what is there in the new law, which was not there in the old law. And that is how one will have to come to various propositions and various issues under the new law. So section 147 starts with, if an income chargeable to tax in case of an assessee has escaped assessment for any year, AO may, subject to provisions of 148 to 153, assess, reassess such income or recompute loss or any other allowance or deduction for such assessment year. And then the explanation says that assessing officer may assess, reassess income in respect of any issues which comes to his notice subsequently. Now, if you compare this with old section 147, firstly, the old section 147 had a section, 3 provisos and 4 explanations, whereas the new section 147 only has 1 section and 1 explanation. So you find that the 3 provisos and 4 explanations have been reduced to only 1 explanation. So the first question which comes to my mind is whether this will have any implication in respect of the new provisions. The answer has to be yes. It will have a great amount of implication in the new provisions. Now, 147 is the main jurisdictional section under which the assessing officer derives power to make a reassessment. And reassessment can be made only under section 147, meaning thereby you have to first satisfy the threshold of 147 and then only you can proceed further. Now, if you compare the old section 147 with the new section 147, you will find that old section 147 had used the word, if an assessing officer has reason to believe that income chargeable to tax is escaped assessment, then he may assess or reassess. The words reason to believe no longer find any mention in the new section. Now the new section says, if an assessing officer, if any income chargeable to tax is escaped assessment, AO may assess or reassess such income or any other income. So the word reason to believe has gone. What are the implications? Under the old law, there are a number of judgments of the court to the effect that reason to believe means live link or nexus. There is to be a reason which leads to a belief that income is escaped assessment. Further, the courts have held that at the stage of reopening, there is no need to form a conclusion or a concrete belief that income has escaped assessment. At a stage of issuing notice under 148, AO will only have to prima facie make out a case that, yes, I have a belief that I think there is an income escaping assessment. So at this stage, there is no need to conclude that there is an income escaping assessment. Now, since the word reason to believe has been removed, and you have, if any income chargeable to tax is escaped assessment, AO may assess or reassess such income, can one say that under the new law, this prima facie belief has now been done away with, and what you have to do at the stage of issuing 148 notice is to form a belief or a conclusion or an opinion that income has escaped assessment. That appears to be one of the probable views, but the Madras High Court in case of IDFC Limited 459 ITR 169 has held that no. Under the new scheme, reasons to believe have been substituted by the words information suggesting income escaping assessment in the first proviso to section 140. More or less, Madras High Court says reason to believe is similar to information suggesting income escaping assessment. Therefore, even under the new law, at the stage of issuing notice under 148, AO will only have to form a prima facie belief and need not conclude that really there is an income escaping assessment. Under the old law, the first proviso stated that if there is a prior assessment, if 4 years have elapsed, then you can reopen only if there is a failure on the part of the assessee to disclose fully and truly all material facts. The number of courts have taken a view that there is a prior assessment, and if the AO, from the very same records which he had before him in the course of assessment proceeding, raises some issue, and if there is no failure to disclose on the part of the assessee, then in such case, reassessment proceedings are barred by limitation. This proviso under the old law now no longer finds a mention under the new law, and therefore this concept of failure to disclose fully and truly all material facts has been done away. So one cannot now rely upon this argument of failure to disclose. At the same time, you will find that there was a third proviso in the old law which stated that if any issue is subject matter of any appeal or reference or revision, then on the same issue, one cannot issue a 148 notice. Again, we don't find this third proviso in the new law. So can one say that, for example, if an assessing officer disallows a particular amount of expenses, say interest expenses of 50 lakh rupees, you go to CIT appeal. CIT will against you. You go to tribunal. Tribunal in your favor. Can an AO reopen an assessment to again disallow the same interest expense? Ideally, the answer has to be no, because you have already won before the tribunal and you are before the tribunal. The issue is subject matter of appeal before tribunal. And therefore, there is something called as doctrine of merger. The assessing officer's order got merged with the order of the tribunal. If an issue is already sub judice, already subject matter of an appeal, then on the same issue, you cannot reopen an assessment. Of course, there is no concept of res judicata in the Income Tax Act, but there is something called as consistency. So we used to argue under the old law, because of the third proviso, you cannot reopen if the issues are subject matter of appeal, reference, or admission. Now the third proviso is no longer in statute. So can one argue that, forget what the tribunal has done, since there is no third proviso, I can still reopen on the very same issue which was subject matter of an appeal? Answer has to be no. It will lead to an ambiguous result and this will create a havoc. The answer in this regard is also that prior to third proviso also, department used to approach or reopen an assessment on the very same issue which was already a subject matter of appeal. In those contexts, there are judgments of the court to the effect that no, you can't reopen, even if there is no such specific embargo, and therefore that provision will also apply under the new law. Even without the third proviso, we can always argue, since it's a subject matter of appeal, you cannot reopen. Now, there is one explanation to old section 147, which provides that in the following case, it is deemed that income has escaped assessment. I'll give you an example. There are some sales which you have offered to tax during the demonetization period. Say, for example, 1 crore rupees. Assessing officer now reopens on the ground that the sales or the money which you have received in the bank account constitutes your undisclosed income and has to be taxed under section 60, read with section 115 BBE at the rate of 60%. Now, your answer would be, no, this has already been offered to tax, already be considered in my income, return of income, and therefore there is no income which has escaped assessment. In the old section, explanation 2 to section 147, clause C and clause B provided that if an income has been assessed at low rate, then it amounts to deemed escape. So under the old law, to tax you at a higher rate, they could have reopened. But that explanation is no longer there in the new section. Now the requirement of new section is income escaping assessment. Since you have already offered the cash deposits or the credits in the bank account as your income, the said receipts cannot be said to have escaped assessment. If you want to tax it at a higher rate, then section 147 is not an answer to that question, because 147 is only if an income has escaped assessment, not to tax an already assessed income at a higher rate. So these are the implications of old explanation 2 not being continued in the new section 147. Similarly, a very interesting issue arises if one again looks at section 147. If any income chargeable to tax has escaped assessment, AO may, subject to provisions of 148 to 153, assess or reassess such income or recompute the loss or the depreciation allowance or any other allowance or deduction for such assessment year. To reopen, the condition is income has escaped assessment. Now, my focus here, and I want to draw the attention to the fact that I am distinguishing between a positive income and allowance of any expenditure or loss. With this thing in your mind, now please appreciate this. If any income chargeable to tax, which is a positive income, has escaped assessment, AO may assess or reassess such income. The word used is such income. And then it is subsequently, it is written, or recompute the loss or depreciation allowance or any other allowance or deduction. What I am trying to highlight is the word income does not include loss, depreciation allowance or deduction, because if that was the case, then there was no need to write after such income or recompute the loss or depreciation allowance or any other allowance or deduction, which means the word income will not include loss, depreciation or any other allowance or deduction. Also, they have used the word such before the word income, and such makes a reference to the first portion of section 147, which states if any income chargeable to tax has escaped. So the point which I am trying to drive is only if a positive income has escaped assessment, he may reopen an assessment. An assessing officer cannot reopen an assessment to reduce the expense or disallow a loss, because the jurisdiction which one derives is only if income is escaped assessment, and income word has been used distinctly from the word loss, depreciation allowance, any other allowance, or deduction. Now, therefore, somebody will argue, sir, the income escaping assessment was again used in the old section, but there they used to reopen assessment even for disallowing any expenses. My counter is, in explanation 2 to section 147, clause B and subclause 4 of clause C specified that where an excessive loss has been allowed or depreciation allowance has been claimed or any other reduction has been claimed, which is excessive, then it is a case of deemed escapement. So under the old law, there was a case of deemed escapement where excessive loss was claimed or excessive depreciation was claimed or excessive reduction was claimed. The same provisions are not available under the new law. And therefore, I would argue you can reopen under 147 only if any positive income chargeable to tax has escaped assessment and not to disallow any expenses, claim, or deduction. Now, in this regard, of course, somebody will say, sir, take this argument, what is the sequitur? Sequitur is, if you succeed in the court, naturally there has to be an amendment in future to take care of all these lacunas. The last point insofar as section 147 is concerned is in relation to the judgment of Bombay High Court in case of Jet Airways, which had in fact followed the judgment of Delhi High Court in case of Ranbaxy. Now the example is like this. They reopen an assessment to disallow expenses of 20 lakhs. In the course of assessment, you satisfy 20 lakhs has been claimed legitimately, it's an allowable expenditure. AO is satisfied. But AO says, no, you have taken unsecured loans of 1 crore and I want to add that 1 crore under section 60 of the Act. He makes an assessment order, reassessment order, and he adds this 1 crore as unexplained cash credit. In such a scenario, the Bombay High Court has held, the Delhi High Court has held that if no addition has been made in respect of the issue for which you reopen the assessment, you cannot make any addition in respect of any other issue. The findings of the Bombay High Court was basis the judgment or basis the provisions of section 147 at that point of time. Section 147 at that point of time read that if AO has reason to believe income chargeable to tax is escaped assessment, he may assess or reassess such income and any other income which has escaped assessment which comes to his notice. So the words used were such income and any other income. So this was interpreted by the Honorable Bombay High Court on the ground that for making addition of any other income, you have to first make an addition on the issue in respect of which you have reopened the assessment. So the judgment of the Bombay High Court and Delhi High Court specifically was on the wordings of section 147. Now, if you look at the new section 147, there is no such wordings that you have to make an addition of such income and any other income. Therefore, the first view which comes to my mind is Jet Airways and Ranbaxy may not be strictly applicable. At the same time, if in respect of any item of income, you are able to convince the assessing officer that no income has escaped assessment, then in that case, he accepts that and he doesn't make any addition, then in that case, you can very well argue in the appellate proceedings that once you don't make any addition in respect of the issue for which you have reopened, then the reassessment proceeding itself AD, which requires an AO to apply his mind and to find out whether it is a fit case to reopen. You had to conclusively form an opinion that income chargeable to tax escaped assessment, since there is no income chargeable to tax escaped assessment, therefore the reassessment proceeding is bad in law. So Jet Airways can apply in another manner that reassessment itself is bad in law. At the same time, just a corollary to this, we have seen a number of cases that reopening is on A issue, but your 142(1) notice requires you to make compliance on 25 issues. It covers everything under the sun. Now, in my personal view, that is incorrect because A is an SOP issued by the NFAC that when it's a reassessment proceeding, your first notice under 142.1 should be strictly in respect of the issue for which assessment has been reopened, and you cannot ask any other issue. Also, the explanation to 147 holds that he can make addition on any other issue which comes to his notice subsequently. It has to come to his notice. He cannot dig out for issues. He cannot make fishing and roving inquiries. So it's only if you give the assessing officer any information in respect of the issue for which assessment is reopened. Basis that information, he comes to a belief, no, there is something fishy in respect of loans, etc. Then he can dig further. But the very first notice cannot be a notice to call for details which are unconnected with the issue for which assessment has been reopened. So this takes care of 147. Now we come to section 148. So 148, before issuing any before making any reassessment, he has to issue you a notice under 148. 148 is a jurisdictional notice which will require to file return of income. The period specified in such 148 notice to file return of income has to be 3 months. However, a notice under 148 cannot be issued unless you have complied with the provisions of 148A wherever required. If 148A provisions are not applicable because of the exceptions provided in the first proviso to 148A, then in such case you directly issue 148 notice. However, either the 148AD order or the 148 notice have to be specifically approved prior to such issuance by the specified authority. Also, an assessing officer can issue notice under 148 only if he has any information which suggests that income chargeable to tax has escaped assessment. Explanation 1 to section 148 defines the term. What do you mean by income chargeable to tax has escaped assessment? It has been defined in an exhaustive manner as to what do you mean by information which suggests that income chargeable to tax has escaped assessment. Earlier, there were only 2 clauses. Then there was an amendment, and now there are 5 clauses. At the same time, explanation 2 states that in these scenarios, it shall be deemed that income chargeable to tax has escaped assessment. Now, coming to various issues which may arise in the context of section 148. Firstly, 148 is a provision to issue notice under 148 before making any assessment under 147. And therefore, conditions of 147 has to continue if you want to make an assessment, which means there has to be an income chargeable to tax which has escaped assessment. Now, under the old law also, there was a requirement to issue 148 notice. The same requirement continues even under the new law. As a result, all the controversies attached to issuance of notice will also continue under the new law. For example, such notice should leave the assessing officer's hand on the last day, before the last day. Notice cannot be issued on a deceased assessee or an entity which is no longer in existence. It should be issued at the correct address, correct email address. Mind you, service on portal without a physical service, without an email, does not amount to a valid service of notice. Notice has to be a signed notice. And once you file return of income, AO has to issue a notice under section 143(2) of the Act. So these are the normal issues which also arise under the old law and also under the new law. Nothing new in that. Before issuing a notice under 148, as you already discussed, you have to follow the procedures under section 148A of the Act. However, you cannot issue a notice unless there's an information which suggests that income chargeable to tax escaped assessment, and you have taken prior approval of the specified authority. Now, what do you mean by information which suggests that income chargeable to tax escaped assessment? It is defined in explanation 1 to section 148. The definition is an exhaustive definition, and therefore, apart from the 5 clauses of explanation 1, there cannot be any 6th information basis which the AO can issue a 148 notice. The first one is information in case of an assessee in accordance with the risk management strategy formulated by the board from time to time. Now, the moot question here would be, and what is this risk management strategy? Apparently, every year, before issuing notice under section 148, before inquiring under 148A, board comes out with an instruction that in which all cases you have to upload the information on the Insight portal. Insight portal is something which is the internal portal of the department. Now, that cannot be construed as a risk management strategy. There has to be some defined strategy, because the section uses the word, or the expression uses the word, risk management strategy formulated by the board from time to time. So, it is already formulated, it is in place. Nobody knows that. When we ask this question to the department, their only reply is, sir, your information was flagged on the Insight portal and therefore we have to reopen. It forms under risk management strategy. Now, here my suggestion to you would be, in all your cases, wherever there is a reopening basis the risk management strategy, please in your reply to the 148 AB notice, you have to ask the AO, because the onus is on the assessing officer to demonstrate that all the conditions have been fulfilled. You please ask the AO, sir, as per your 148 AB notice, your reopening basis the risk management strategy. I request you to please give me a copy of the risk management strategy, and also to show how my case fits in this risk management strategy. So, the onus is on the AO to show that your case fits in the risk management strategy, because there is no such strategy. And how do I argue before the courts or before the CITAPL or before the tribunal that the reassessment is bad in law, because my case does not fall in the risk management strategy? Just giving the word or the phrase risk management strategy will not be sufficient. In fact, on this, I think there is a writ petition pending before the Rajasthan High Court, where they have challenged the validity of this provision. And I think last year, in December or November, even the Bombay High Court was concerned with what do you mean by the word risk management strategy. This is one. Two, the second of case of information is where there is any audit objection to the effect that assessment in the case of an assessee has not been made in accordance with the provisions of this Act. So, audit objection is now a valid information. But to invoke this clause, there has to be a prior assessment. It's only when your income has been assessed in a 143.3 or a 147 proceeding can the audit team verify the records and take out the issues. Such audit objection is a valid information under explanation 1 to section 148. But the audit objection has to be to the effect that assessment has not been made in accordance with the provisions of. You have to form an opinion that whether this has escaped assessment or this has been wrongly allowed or something of that sort. Audit objection cannot say this has not been verified, because in that case, one cannot conclude that assessment has not been made in accordance with the provisions of this Act. A, there has to be a prior assessment. B, there has to be a proper formation of opinion by the audit team that assessment has not been made in accordance with the provisions of the Act. Now, under the old law, we had judgments of various courts across India that simply based on audit objection, you cannot reopen. If an audit objection is in respect of any factual discrepancy, you can reopen. But if an audit objection takes a view, a legal view, which is contrary to what the AO has taken, then in that case, you cannot reopen. In fact, in most of the cases before the Bombay High Court, nowadays, the Bombay High Court asks the department that if there is an audit objection, please also place on record what was the reply of your assessing officer to this objection. Because in most cases, assessing officer replies back to the audit team that, no, what I have done is correct, your view is not correct. Why this is essential? Because it is the view of the audit team that income has escaped assessment, whereas section 147 requires assessing officer to form his view whether it is a fit case to issue notice under 148. And if the assessing officer thinks that what view has been taken in the course of assessment proceeding is right, then in that case, despite there being an audit objection, you cannot reopen. That argument which was there under the old law will still continue under the new law. At the same time, we also used to argue that audit objection given to the AO and AO recording is reason to believe that income has escaped assessment amounts to change of opinion, because this very issue was subject matter of consideration in the original assessment proceeding. So AO in the original assessment proceeding stated that a particular expense is an allowable deduction. Now the audit team says, no, that's a capital expenditure you have wrongly allowed. Specific query raised, reply filed. If that is the case, then you cannot reopen to review your own assessment. It's something what the Supreme Court held in the case of Calvinator, that it is an inherent check, inherent test, and review of assessment cannot take place under the guise of reassessment. Controversy arose before the court as to whether change of opinion will also apply under the new law. And we have 3 Bombay High Courts, 1 Gujarat High Court, 1 Karnataka High Court, 1 Madras High Court under the new law, to the effect that you cannot reopen on the basis of change of opinion. Of course, also Delhi High Court. So if a particular issue has been verified in the course of original assessment proceeding, now you cannot reopen on the ground that it has been wrongly allowed, wrongly not taxed. So change of opinion concept continues even under the new law. The department cannot argue that the concept of change of opinion has gone with the old law. The next 3 items of information suggests that income has escaped assessment is the information received under an agreement referred to in section 9090A, information made available to the assessing officer under the faceless verification scheme under 135A, and any information which requires action in consequence of the order of tribunal or court. So that also falls as information suggesting income escaping assessment. But provided, so insofar as the first and second item is concerned, that information received under DTAA or information received under 135A, simplicity information is not sufficient. It is to also suggest that income has escaped. For example, information received by the AO under DTAA is that so and so holds a property in London. This is the information. Can he reopen basis this information? Answer has to be no, because it does not lead to any suggestion that income has escaped assessment. It only states that the person is holding a property. So therefore, a simplicity information, for example, the second example is so and so has deposited 10 lakh rupees cash in the bank account. So what? Whether the cash deposit is income or not, nobody has verified. So simplicity information that a person has deposited cash in the bank account cannot suggest that income has escaped assessment. Or so and so person has purchased a property and that information is received by the assessing officer. Again, that will not suggest that income has escaped assessment. That is an information, the starting point to initiate an inquiry. You conduct an inquiry, find out whether the acquisition or the investment is proper out of disclosed sources. Only if these things happen, then you can come to a conclusion or come to an opinion or come to a belief that no, there is something fishy and income has escaped assessment. But simplicity information that is assessee has invested, purchased, etc., cannot be a ground to reopen an assessment. Now, we come to the explanation 2, which deals with cases where it is deemed that information, there is an information with the AO which suggests that income has escaped assessment. But before coming to that, let me compare explanation 1 with explanation 2. Explanation 1 says, these are the information which suggest income has escaped assessment. Explanation 2 says, these are the cases where there is deemed information which suggests that income has escaped assessment. Point which I am trying to make is, we have seen a number of 148 AD orders where the AO writes, so this information is flagged on the portal, therefore I have to reopen because there is an information which suggests that income has escaped us. Meaning thereby, irrespective of what your argument is, irrespective of what your submission is, since there is an information on the inside portal which gets covered in the risk management strategy, I have to reopen. The answer is no. You may have an information, but you have to issue me a show cause. I have to reply, and basis my reply, you have to form a belief whether it's a fit case or not. Simplicity information under explanation 1 cannot give you a reason to reopen under 148. And that argument gets strength when I compare explanation 1 with explanation 2. Explanation 2 says it's a deemed case of information testing. The same word, the same deeming fiction is not used in explanation 1. Therefore, simpliciter receipt of information is not sufficient to reopen an assessment because it is not deemed that AO has information suggesting income escaping assessment, and you cannot simply reopen basis the information you receive under explanation 1. Coming to explanation 2, if you are searched after 1421, if the books of accounts, documents, assets are requisitioned after 1421, if there is a survey conducted in your case after 1421, or if Mr. A is searched, but certain assets are found which belong to you, and a satisfaction in this regard is recorded by your AO, or if Mr. A is searched after 1421 and certain documents or books of accounts are found and seized, the information contained therein relate to you or pertain to you, then in such case, AO shall be deemed to have information which suggests that income chargeable to tax has escaped assessment. Earlier, the deeming fiction was only for 3 years prior to the year of search or survey. But by Finance Act 2022, they have removed the word 3. Therefore, it is deemed that your AO has information to suggest that income has escaped assessment for all years up to which he can reopen. Now, we come to some of the issues in this explanation, etc. Search 153A, 153C if prior to 1421. He can reopen under 153A, 153C, but he cannot make any addition for those years which are unabated if no incriminating material is found in respect of the additions made. All those concepts probably has now gone under the new law. 2. In the earlier regime, pursuant to survey, there was no specific benefit given to the department to reopen on the basis of a survey. They had to reopen following the normal process of reassessment. Under the new law, also they have to reopen under 148, but there is one benefit given to the department that if there is a survey, it shall be deemed that AO has information suggesting income escaping assessment. Now, this survey will not include TDS survey under 133A, subsection 2. Most important question which I have faced in recent time is, if there is a search in case of a person, and suppose the AO has formed some incriminating material to the effect that there is an income escaping assessment in year 3, year 5, and year 6 prior to the year of search. Can we reopen all 10 years because there is a search and because there is a deemed information under explanation 2 to 148? I have seen cases where a person is searched, his 3 years prior to the year of search are opened under 149(1)(a). It has to be, of course, opened with the prior approval of the principal commissioner. The approval form says income escaping assessment, not applicable. Reasons to believe, not applicable, since deemed information. Therefore, approved by PCID. My point, which I am trying to convey, is there may be a search, there may be a survey. Nonetheless, you still have to form a belief that income has escaped assessment, because 148 is to make an assessment under 147, and 147 can trigger only if there is an income escaping assessment. AO cannot write, there's a search, there's a deemed information. I don't have to see your books of accounts. I don't have to see your incriminating material. Just because it's a search, I will reopen all your earlier 10 years. This is insofar as search is concerned. It becomes more draconian when you see what will happen in case of a third party. Because in third party, what the explanation says is, to give an example, there's a search in case of your client. In your client's books of account, they found a ledger that professional fees were paid to chartered accountant of rupees 60 lakhs. Is there a books of account document found seized? Answer is yes. Is there any information contained in these books of accounts or documents found or seized pertaining to or relating to you? Answer is yes. Can therefore they reopen under 148? Answer is yes, because the requirement of the explanation is they have to find a books of accounts or documents, and any information contained therein should relate to you. There is no requirement to show that this information also suggests that income has escaped assessment. Contrast this with wordings of 153C. The 153C, an assessing officer can reopen under 153C only if he is satisfied that materials found will have a bearing on determination of total income. Now, what will happen in case of such third-party situations? They need to only have an information that material pertains to you or information contained therein relate to you. And in such cases, under 148A, there is not even a requirement to initiate a 148A proceeding. They'll directly issue you 148. Therefore, my answer to this is, though there is a deemed information under explanation 2, but you cannot bypass the requirement of 147, and you can only reopen if any income chargeable to tax has escaped assessment. Even if the starting point of issuing 148 notice of there being an information suggesting income escaping assessment has been satisfied because of explanation 2, still you will have to show to the court or to the appellate authorities that no, there was really an income chargeable to tax escaped assessment. Because the section doesn't say deemed information pertains to only 1 year. Section says he shall be have deemed information which suggests that income has escaped assessment. So even if material is pertaining to 1 year, they can reopen all 10 years. It's a problem. Now, under 149(1)(b), if I want to go beyond 3 years up to 10 years, I still will have to fulfill the conditions of income escaping assessment of more than 50 lakh. It's represented in the form of asset, etc. Can, in case of search and survey where there is a deemed information, still AO will have to fulfill the requirements of 149(1)(b? The answer is yes. If you want to go beyond 3 years, whether it's a search, whether it's a survey, whether you are a third party search in case of another party, AO will have to still fulfill the requirement of 149(1)(b. That is, he must be having in his possession books of accounts, documents, evidence which reveal that income chargeable to tax of more than 50 lakhs has escaped assessment. And the last point in respect of this explanation 2. Many a times we have seen that if there is a search after 1421, and basis the search, your assessment is sought to be reopened. Then AO issues you 148A, he asks you to file reply, and he'll pass 148AD order, and then he'll issue 148 notice. Now, in my humble submission, if basis search of one person, you are reopening assessment of another person, you are not required to follow 148A provisions. You are directly required to issue 148 notice. Now, how this will help you? Two things. Suppose within 3 years, he issues a show cause, asking you to file reply. You file a reply, he passes an order 148AD after 3 years. Now, what you will argue? since it is in relation to a search after 1421, you are not required to issue me 148A. Therefore, 148A proceedings are bad in law. You are directly required to issue me 148 notice. And if you consider 148 notice, it is issued beyond 3 years. As a result, approval is of a wrong authority. And B, income escaping assessment is less than 50 lakhs. This can help you. Also, in case of a third party, that is search in case of a party, but in your case, they want to reopen, there are requirement of 2 approvals. Again, if you look at explanation 2, where it is stated it is deemed to be an information suggesting income escaping assessment, explanation says where AO is satisfied with the prior approval of PCCIT or PCIT. So before issuing 148 notice, if he receives any material from AO of search party, he has to first record a satisfaction that it pertains to me, it belongs to me. Such satisfaction has to be approved by the principal commissioner that yes, the material belongs to me or pertains to me. And then you have to issue notice under 148 again with the prior approval. If it is within 3 years of PCIT, if it is beyond 3 years by CCIT or PCCIT. So in case of 153C type of cases, there has to be 2 approval. And if you find there is only 1 approval, the proceedings are bad in law. Now we have some judgments in the context of 148A, 148. If there is no income which is escaped assessment, I am able to show, for example, Delhi High Court, investment in share capital is a capital account transaction. High Court quashed the notice. If the information itself is incorrect and I show to the court information is incorrect, and the courts have also struck down the notices. Notice unsigned, bad in law, Bombay High Court, Allahabad High Court. At the same time, there is a contrary Delhi High Court judgment in case of Sumanjit Agarwal that even if it is unsigned, it's a valid notice. In my personal view, notice has to be signed. It can't be an unsigned notice. Also, the date of dispatch is a date when a notice or email has been sent to you. Mere putting on the portal is not sufficient, is what the Delhi High Court holds in Sumanjit Agarwal. Notice issued in the name of a non-existent person held to be bad in law. Bombay High Court, Delhi High Court. Now, this is the Madras High Court which has taken us back to the old position. Madras High Court says mere information is not sufficient. Such information should suggest that income has escaped assessment. Which means it is similar to reason to believe, which means there has to be a live link or nexus. If there is an information, but it does not show income escaping assessment, you cannot reopen. So therefore, we are again back to the same position which was prior to amendment. There has to be a live link or nexus before reopening the assessment. Same view taken by the Bombay High Court. Delhi High Court and Calcutta High Court also has taken the same. So now we come to section 148A. 148A, courts have taken a view that under the old law, we had GK and drive shafts. GK and drive shaft provided that after I receive a notice under 140, I have to file my return of income. Thereafter, I'll ask reasons recorded to reopen the assessment. AO will give me reasons recorded. I have to file objections. A has to pass an order disposing objections. And I can challenge the notice under 148 and the order disposing objections before the High Court in a writ jurisdiction. Same procedure has now been codified in 148A. Only difference is the procedure with the GK and drive shaft judgment provided had to be followed after 148 notice is issued and after reasons were recorded. So when the reasons were recorded earlier, AO did not have the benefit of the reply of the SSC. Under the new law, same thing precedes the issuance of notice under 148. So, before issuing notice under 148, he'll give you an inquiry, will issue show cause, see, I have got this information, you please reply. You reply, he is now wiser. Oh no, this is incorrect. Oh no, we cannot proceed on this. Oh, see, this also has to be verified, etc., etc. And he will pass a proper speaking order dealing with your case, stating it to be a fit case or not. So really, the provisions of GK and drive shaft has been codified in 148A. But in these situations, provided in the first proviso, no need to follow 148A procedures. A, where search is initiated. B, where search initiated in case of a third party, and your case is reopened because the material or assets belong to you or the information contained therein relate to you. And also in a case where 135A provisions have been invoked or information has been collected in the faceless verification step. Insofar as 148A is concerned, the Supreme Court in case of Ashish Agarwal has held that it is mandatory to follow 148A. 148A is in the nature of condition precedent. 148A is sort of a game changer, is the word used by the Supreme Court. And therefore, if you don't follow 148A provisions, you have therefore violated the jurisdictional requirements for issuing notice under 148. Proceedings have to be treated as bad in law. One of the interesting issues which comes up regularly before the court is, he issued me a show cause. In the show cause, relying upon some search, some material which is supplied to him. But is he required to give me copy of the material or not? Supreme Court in case of Ashish Agarwal says documents and material to be provided. There's an internal circular of the board of 1st August which says document and material to be provided. The Bombay High Court and the Delhi High Court under the old law have held that document have to be provided, which judgments would apply with equal force even in the new law. Therefore, it is wrong to say documents are not required to be provided. Documents have to be provided. AO has to give you a minimum time of 7 days to reply. AO can't say reply within 3 days or within 5 days. He has to give you minimum time of 7 days to file a reply. You will file a written submission. Is he supposed to give you a personal hearing before passing an order? The answer is yes. He has to give you personal hearing if you insist on a personal hearing, which is also recognized by the board circular of 2022, and which is what also the Bombay High Court has held that in Tata Capital Financial Services. While he passes the order under 148 AD, he has to consider all your submissions, all your arguments, and then he has to pass an order. AO cannot write in the 148 AD order, you have given voluminous documents, I will consider in the course of assessment proceeding. In that case, there is no purpose for you to pass a 148 AD order. You have to consider and pass a speaking order, and you cannot pass a non-speaking order not dealing with any of the contentions raised. Now, 148 AD order is not an appealable order, and therefore, the only way to challenge this is you can file a writ petition before the High Court. Can you file an appeal against it? Probably yes, because Supreme Court in case of Genpact has held that if an assessee denies his liability to be under the Act, then he can challenge that order even if there is no particular reference to 148 AD in section 246 or 246A. But my only problem here is, if I challenge in an appeal, firstly, the Commissioner Appeal says that this order has been passed with the prior approval of Principal Commissioner. In that case, I cannot sit in an appeal over an order passed by my superior. And B, if you file an appeal, Commissioner Appeal has no power to grant you stay. So, you will challenge the 148 AD order in an appeal. At the same time, your reassessment is going on. There is no stay. Nobody is going to hear your appeal. And therefore, there is a complete chaos. Can you do a revision under Rule 64? The answer is no, because order is passed with the prior approval of PCIT or CCIT. So, you cannot do a revision under 264 because the same person cannot be judged in the cause in which he has himself granted an approval. There is a probable solution that if a reopening is within 3 years with the prior approval of PCIT, then you may file a 264 application to the CCIT or PCCIT. That can happen. But again, they don't have a power to stay. Naturally, they have to pass an order within 1 year from the date of filing of the revision application. I don't see any serving of any purpose because it has been approved by the department, and therefore they'll not really reverse that order. Under the old law, we had judgments of Supreme Court and various high courts which held that I cannot improve upon the reasons. Can the same provision apply even under the new law? And if yes, what will be constituted as reasons? 148A show cause or 148 AD order? Now, this is important because many times we have seen AO issues show cause basis on information received. Information says income escaping an assessment in respect of A issue. You file a reply. AO satisfied. No, nothing has escaped assessment insofar as A issue is concerned. But there's a B issue in respect of which income has escaped assessment. Therefore, he passes the 148 AD order. This amounts to improvement. Courts have taken a view under the new law that you cannot go beyond the show cause notice issued. If your show cause says A, give detail regarding A issue, A assessee has given the information, and if you go beyond the show cause notice on any issue which was not even referred to in the show cause notice, order under 148 AD is bad in law. Lastly, who has to issue a 148 notice? Now, this controversy arises because of section 151A. 151A states that central government will frame a scheme for faceless issuance of 148 notice and for subsequent reassessment proceeding. Utilizing that power, they issued a notification number 18 of 2022 dated 29th March 22, and that notification says a reassessment proceeding and issuance of notice under 148 shall be done in an automated manner through automated allocation system and in a faceless manner. Throughout the country, petitions have been filed that jurisdictional assessing officer cannot issue 148 notice after a notification has been issued under 151A, which states that notice under 148 has to be issued by a faceless assessing officer. And you also have a favorable judgment of the Telangana High Court, which is a very detailed order passed by His Lordship Justice Sam Koshi, 295 Taxman 652, which held that notice under 148 has to be issued by the faceless assessing officer and not by jurisdictional assessing officer. Now, matter is pending before the Supreme Court. At the same time, Calcutta High Court single judge has taken a negative view by relying on the notifications which say that JAO and FAO both have concurrent jurisdiction, and therefore JAO can also issue notice under 148 of the Act. So this issue, which is the boiling issue, if ultimately Supreme Court takes a view or some other High Court take a view that no, notice under 148 had to be issued in a faceless manner, then whatever notices have been issued till date under the new regime, all are bad in law. Now, there are exceptions to 148A proceedings. A in case where search has taken place, B in case where search has taken place in case of a third party and material has been found and satisfaction has been recorded, and 3 in case where any information has been received under a scheme notified under 135A. First and foremost, in case of survey, though explanation 2 says deemed information, still AO has to issue a 148 notice, A notice, show cause notice. You have to file a reply. He has to pass an order. The point which I am trying to convey is, despite there being deemed information suggesting income escaping assessment, in case of survey, statute requires the assessing officer to follow 148A procedures and then find out whether it's a fit case to issue notice under 148 or not, which means simpliciter explanation 2 deemed information is not sufficient to reopen an assessment, and this will apply with equal force to search cases and third party cases. AO cannot write, there is a search, I can reopen for 3 years, deemed information, I am not required to see whether income has escaped assessment. So there is no. Deemed information is a starting point, but same thing is there in survey proceedings. But in survey, you are required to follow 148A, which means deemed information itself is not sufficient to reopen. Similarly, in search, though you are not required to follow 148A, deemed information itself is not sufficient. You still have to come to a belief that income has escaped assessment. Now, there is a difficulty which arises in cases where 148A procedures are not to be followed. In such cases, how does one challenge such notices before a writ court to stop the AO from proceeding further? Now, here I think you can follow old judgments of Supreme Court in case of GK and Tribesharp. You can ask the assessing officer, provide me with the reasons recorded, with the approval, and show me you have fulfilled the conditions of 147. He has to give you copy of approval and reasons recorded as per their own circular. You can file an objection, and once you file an objection, he may pass, he may not pass an order under 148 disposing of your objections. In either case, you can directly challenge it before the High Court. What if AO does not follow 148A procedures? So, for example, if he has not issued show cause, not passed 148 AD order, end of the story. 148 notice is bad in law. But say, for example, he issues show cause but does not give you material. He issues show cause, gives you only 3 days time to file reply. He issues show cause, you ask for a personal hearing, does not grant you personal hearing. He issues show cause, you file a submission, but submission has not been considered. All these cases, according to me, it's a jurisdictional violation, and you cannot say, okay, I will remand it back to the AO. In such cases, court should quash the 148 notice, 148 AD order, and if the AO wants to come again with a fresh notice, he can do that, but there is no scope of going back to the AO in a set aside proceeding. So all these judgments of Bombay High Court, Kerala High Court have quashed and set aside the proceeding. Show cause notice issued in the name of deceased person has been struck down by the Bombay High Court, Gujarat High Court. And in all these cases, Delhi High Court and some cases of Bombay and Allahabad High Court, where there was a violation of 148A procedures, court have set aside and not merely quashed it. In these cases, Bombay High Court, Chhattisgarh High Court, Delhi High Court, where the courts have held that you cannot go beyond a show cause notice. In fact, this was a specific question before the Calcutta High Court Division Bench. AO reopened on A ground. Assessee satisfied the AO, I have never received this A entry. AO says, yes, you have not received A entry, but you have received this B entry, which is escaped assessment. Assessee filed a writ petition before single judge of the High Court. High Court said, okay, no, you have not been given opportunity of being heard. Go back. Assessee filed a writ appeal before the division bench. The specific question before the division bench was whether in such case matter should be remanded to the AO or should be quashed and set aside. Calcutta High Court says there is no question of remanding back to the AO. He has gone a completely different basis. Therefore, notice under section 148 and 148 AD be quashed and set aside. And if he wants to reopen, as per law, he can reopen. So, specific question whether to remand or to quash, court held that it has to be quashed. Now, the most important and crucial section is section 149, which deals with the limitation. A 148 notice can be issued within 3 years from the end of the relevant assessment year without any condition precedent about the threshold or about some other criteria. Of course, AO will have to still require to be satisfied the conditions of 147, income escaping assessment, 148, information suggesting income escaping assessment, 148A procedures, and approval under 151. If he wants to reopen beyond 3 years up to 10 years, then there is an added condition, a serious condition which he will have to fulfill. Then there are various provisos prescribed on this limitation, how to calculate the limitation period. Now, if I want to go beyond 3 years and up to 10 years, what are the conditions which I am required to fulfill? Now, this is very important because this is where the crux of the litigation will lie in future, because in most of the cases they reopen beyond 3 years. So what are the conditions which the AO will have to fulfill? If you look at section 149 1B, AO has in its possession. So AO should have in its possession what? Books of accounts, other documents, or evidence. Now, if you contrast this with explanation 1 to 148, in explanation 1, to issue notice under 148, AO needs to have information suggesting income escaping assessment. But if he wants to go beyond 3 years, AO should have in his possession either books of accounts, documents, or evidence. Clearly, legislature has in 149(1)(b) not used the word information. They have used the word books of accounts, documents, or evidence, which is more than the information. Simply cited information will not be sufficient to reopen beyond 3 years. Your information on the inside portal, or there's an information passed on to the assessing officer by some other assessing officer, will not be sufficient to reopen the assessment. 2, I think for the first time, the legislature has used the word evidence. So they use the word books of account, other documents, or evidence. What do you mean by evidence? Evidence is something which proves that income has escaped assessment. It's a very serious word. And therefore, my personal submission is, or my personal belief is, even the word books of accounts or document should be in the nature of evidence. Can't just reopen because AO has in his possession books of accounts. Such books of accounts should give an evidence that income has escaped assessment. Now, there was this case before the Madras High Court IDFC Limited where the reopening of assessment was based on the very same records which were available before the assessing officer. There was a prior assessment and now they reopened beyond 3 years and he wants to disallow some expenses, he wants to disallow some loss, etc. Assessee argued there is no new tangible material. Under 149(1)(b), you have to be in possession of books of accounts, documents, or evidence, which should be something more than what has been filed in the course of original assessment proceeding. Madras High Court accepted this argument, and therefore, if you want to go beyond 3 years, there has to be a new tangible material to reopen the assessment. So therefore, AO should have in his possession books of accounts, documents, and evidence which should reveal that income chargeable to tax has escaped assessment. Now, please focus on the word reveal. Explanation 1 to 148, first proviso to 148 states that information which suggests that income has escaped assessment. Old law, reasons to believe that income has escaped assessment. But if you want to go beyond 3 years, it has to be more than suggestion. It has to be something which should reveal that income has escaped assessment. Now, how do you define the word reveal? Reveal should be something which discloses, which shows, जो दिखाता है, जो बताता है, which is something more than suggestion, something more than belief, something more than opinion. It is something which actually conclusively states that yes, there is an income escaping assessment. So if you read the entire thing in one go, AO has in his possession books of accounts, documents, or evidence, and it reveals that income has escaped assessment. So really speaking, if AO wants to reopen beyond 3 years, he can reopen only if has a concrete information which conclusively shows income has escaped assessment. He cannot reopen to make verification inquiry. A lot of times we see in the order, he issues show cause, you file a reply, AO says, no, this will require further verification, which can only be done in the course of original assessment proceeding. Clearly, there is nothing which reveals income escaping assessment. You cannot reopen to make fishing and roaming inquiry. These are very serious words. And this condition of 149(1)(b) is in addition to information suggesting. So mere information suggesting will not be sufficient. Lastly, income escaping assessment should be 50 lakhs or more. Of course, this is the threshold which has been prescribed. And now, not only all these conditions, but the income which has escaped assessment should be represented in the form of asset, expenditure, or entry in the books of account. So there has to be an income which has escaped assessment, but such income should be represented in the form of asset. or an expenditure or entry in the books of account. So it's a very crucial term. And one has to keep in mind that you have used the word as income represented in the form of asset, expenditure, or entry. They use the word in the form of. When I come to an asset, asset is of course defined in an inclusive manner, and therefore all assets will be included. But to give an example, or rather, let us take as reference of a similar condition in fourth proviso to 153A. Under 153A, pursuant to search, AO can reopen up to 6 years. But for going from 6 to 10 years, AO has to be in possession, books of accounts, documents, evidence, which reveals income as escaped assessment in the form of asset of more than 50 lakhs. So identical phrase in the erstwhile 153A, fourth proviso, is now there in 149(1)B. In that context, board had issued a circular number 2 of 18 dated 15 February 18, which specifies what do you mean by income represented in the form of asset. And they say, in order to protect the interest of the revenue, in cases where tangible evidences are found, they have specifically used the word tangible evidences are found during a search or seizure operation, and the same is represented in the form of undisclosed investment in any asset. So you have to be found to have invested. This investment should be an undisclosed investment in any asset. Not only an income is represented in the form of asset, because see, any income which is a credit entry in the books of account, corresponding debit has to be an asset, either cash, receipt in cash, receipt by a banking channel, or debtors. So all income are actually an asset. That is not the condition of 149(1)B. 149(1)B says income is represented in the form of asset, which has to be in the nature of undisclosed investment in any asset. So if they come to your place, they search you, they found out you had an undisclosed bank account in the year 15-16. That is undisclosed investment in an asset. Or you had purchased a diamond or a gold jewelry in 15-16. That is an investment in an asset. Or you have purchased something valuable in the year 15-16, not disclosed. That is an undisclosed investment in an asset. But somebody says, somebody's statement, you have paid on money, cannot be a conclusive proof that you have invested. Or some loose paper found which shows you have paid some money or you have received some money on sale of asset is not sufficient, because you have not been found to be owner of any asset. There has to be an undisclosed investment in any asset. It's a new term, less litigation until now. But we have judgment of Bombay High Court in a case of Ashok Commercial 459 ITR 100, which has held that writing off of a bad debts cannot satisfy the requirement of income represented in the form of asset. And similarly, Madras High Court and IDFC has held that bad debts, disallowance of expenses, or loss is not an asset. So there is one query which arises here. Suppose the AO's belief is, I have taken unsecured loan or a share application money, which is bogus. Can he say it is an income escaping assessment represented in the form of asset? My personal view is it is not an asset, it's a liability. Therefore, you cannot say income represented in the form of asset, because you have to repay it. Somebody will say it is your own money and therefore it's an asset. The answer is no. All corresponding liabilities are or have a corresponding asset. You cannot say it's an asset. And it is for this reason you will find that amendment has been made. Earlier in financial year 21-22, 149(1)B only spoke of asset. Finance Act 22 amended and expanded the scope of section 149(1)B to also include expenditure and entry in books of accounts. So unsecured loan or share application money can be an entry or entry in the books of accounts, and income is represented in the form of such entry. Now coming to the second aspect, income represented in the form of expenditure in respect of a transaction or an event or an occasion. And income cannot be represented in the form of expenditure. Expenditure is something going out, it's not your income. But when the legislature says income represented in the form of expenditure, naturally it has to be an expenditure which is a bogus expenditure or an unexplained expenditure. So only in those kind of cases 149(1)(b) can be triggered. Similarly, income represented in the form of entry in the books of account. Income in the form of entry has to be a case of a bogus accommodation entry or an entry which does not reflect the true form, true substance, but only shows what is in form. Not all entry in the books of can be termed as income. Income has to be represented in the form of entry, means it has to be an accommodation entry. Now, of course, they have expanded the scope of section 149(1)(b). Earlier, it was per year 50 lakh. Then they thought, no, it can't be per year 50 lakh. But if in more than 2 years, if you have invested in an asset or if you have incurred any expenditure and total is 50 lakhs or more for 2 years, then they can reopen both the years. We come to the first proviso. I'm sorry, we'll come to the first thing, which is 149 provision deals with limitation to issue 148 notice, not a 148A notice. So you have to verify the limitation as on the date on which 148 notice is issued and not 148A. 148A may be issued within the time limit prescribed. But then AO sleeps over it. And after 1 year, he issues 148 notice. If it's barred by limitation, it is barred by limitation. We come to first proviso, and mind you, many people are still under the belief that a reassessment can take place even after 6 years up to 10 years. They have expanded the time limit. But take it from me, up to assessment year 21-22, they can still reopen only up to 6 years because of the first proviso. And as per first proviso, in simple language, first proviso says, if at a particular point of time you cannot reopen under the old law, then at that point of time you cannot reopen under the new law. To give an example, I am today 21st March 24. Can I reopen assessment year 15-16 on 21st March 24 under the old law? Old law says 6 years. 15-16, 6 years expires on 31st March 22. Therefore, on 31st March 24, I cannot reopen under the old law. If I cannot reopen under the old law on 31st March 24, I cannot even reopen under the new law, which means time limit is still 6 years to reopen under the new law up to AY 21-22. However, if you are searched or if there is material found in the course of search in case of third party, and therefore you will be otherwise governed by 153A or 153C, then in such case, they can go from 6 to 10 years, because the first proviso says only if you can reopen under the old law, 148, 153A, 153C, then you can reopen under the new law. So if you are searched under the old law, he can reopen up to 6 years without any condition, 6 to 10 years if income chargeable to tax has escaped assessment in the form of asset. Similarly, under the new law, if search is after 1421, he can reopen 6 years. After 3 years, he has to form that belief income in the form of asset, expenditure, or entry. And 6 to 10 years, he can reopen because he could have otherwise reopened under 153A fourth proviso. But mind you, 6 to 10 years, he can reopen only if income represented in the form of asset is escaped assessment. Because under the old 153A and 153C, for going beyond 6 years up to 10 years, an assessment could have been reopened only if income represented in the form of asset is escaped assessment. So if today he forms a belief for 6 to 10 years, 7 to 10 years, that there is an income escaping assessment in the form of expense in the books of account, and if he wants to reopen, he cannot reopen because for the very same expense, he could not have reopened under the old 153A provisions because there the requirement is only if income has escaped assessment in the form of asset. So this is the chart which gives which year can be reopened up to which year under normal circumstances, not under search provisions. You can take it later on. Now we'll deal with fifth and sixth proviso. Fifth proviso states that time limit given to file reply to a show cause notice shall be excluded in computing the period of limitation. So if on 31st of March you have been issued show cause for AY 18, 19, 31st March 22, 3 years expires on 31st March 22, you have been given 10 days time to file reply. You file reply on 10th April. He has to pass an order. He passes an order on 11th April, which is within 3 years. Because fifth proviso says, exclude the period given to an assessee to file reply, exclude the period for 140 if there is a stay of proceeding, and if after exclusion of such period, if assessing officer has less than 7 days to pass a 148 AD order, then such period will be extended to 7 days. So, since the show cause is issued prior to issue of notice under 148, time limit given to file reply shall be excluded. Now, it's very important to note, and we already have a judgment of Bombay High Court. AY 1516, 6 years expires on 31st March 22. AY 1617, 6 years expires on 31st March 23. As per first proviso, you can reopen only up to 31st March 22 or up to 31st March 23. Say issues you a show cause for AY 1516 on 15th March 22, ask you to file reply for 20 days. You file reply on 5th April. He passes an order on 15th April and issues notice on 15th April. As per them, time limit given to file reply has to be excluded. Therefore, 148 notice is valid in the eyes of law. Bombay High Court has taken a view that fifth proviso cannot override first proviso. So wherever 6 years are expiring, AY 1516, 31st March 22, AY 1617, 31st March 23, AY 1718, 31st March 24, notices under 148 has to be issued latest by 31st March of that year. You cannot rely on fifth proviso to exclude the period of time given to file reply. It's a very crucial thing. All notices issued after expiry of 6 years are therefore barred by limitation. Lastly, I come to sanction. I'll just touch upon sanction. I think it's already 5:45. I'll just touch upon the sanction part. If it is within 3 years, sanctioned by principal commissioner or commissioner of income tax. And if it is beyond 3 years, sanctioned by principal chief commissioner or principal director general. And where there is no such authority, then by director general or chief commissioner. AY 1890, 3 years expired on 31st March 22. They issued me a 148 notice on 6th April or 7th April 22. It is within 3 years period, because if I exclude fifth proviso time limit, time given to file reply, then it is within 3 years. Now, we argued before the Bombay High Court that exclusion of period for giving reply is only for the purpose of 149. It will not apply to 151. And therefore, insofar as 151 approval is concerned, notice under 148 has been issued beyond 3 years. Approval of principal commissioner is bad in law. Bombay High Court has consistently passed order in at least 50-60 cases. Approval is bad in law. Notice is bad. Similarly, now there's an amendment. We have also taken a view that prior to amendment by Finance Act 2023, after 1423, prior to 1423, approval after 3 years is to be by PCCIT or PDGIT. And only if there is no such authority, it can be by DGIT or CCI. So, for example, in Bombay, we have a principal chief commissioner of income tax. In Delhi, we have a principal chief commissioner of income tax. If there is a principal chief commissioner, approval cannot be given by chief commissioner. It has to be given by principal chief commissioner. In all search cases, I have seen cases where CCIT central has given approval, and I have seen some cases where member investigation CBDT has given approval. According to me, if it is beyond 3 years, these are bad in law. So I think we can 545. Sachin bhai?
Yes, sir. We can start with question answer.
Yeah, we can start.
Okay, okay. So we have around 5 questions.
Yeah.
Not all are actually relating to the topic, but I will still go ahead and ask them.
Yeah.
So the first query is from Karunakar. The query is the assessment done
Hmm.
and refund received. One second, sir. I'll just switch on my video. Okay.
Yeah.
The query is the assessment done
Hmm.
and refund received.
Hmm.
Received now communication that there is a mismatch between AIS and income tax return,
Hmm.
stating that only 50% of dividend income is shown in the returns.
Hmm.
The return is now prepared based on Section 5A of Income Tax Act. 50% of the balance dividend income is shown under the vice return.
Yeah.
However, there is online response. However, online response could not be submitted as no option is available. Right, a token is raised. So what he's asking is like, is there any way out?
This is an online thing.
Yeah, right,
And
right,
it
right.
has really no relevance
Okay,
unless
right,
you receive
exactly.
a 148 AB notice
Then
where you can file
exactly.
a reply.
Right, sir, right, sir, right, sir. The second is from Sankuni. The question is, when an assessment order is received stating that no demand is there and the calculation attached to it shows a tax liability of some crores from the faceless assessment, what
Yeah.
is the option left?
There is a technical glitch we have faced.
Right,
Two
right.
options. File a
Okay.
154 with your AO to get it
Okay.
rectified because there is a technical glitch.
Okay.
And suppose it persists and there is no action taken,
Okay.
you may either file an appeal under 246, but it will take ages to get
Right.
resolved. You may file a revision under 264 with your principal commissioner and he has to pass an order within 1 year.
Okay.
And if you are very much aggrieved by the communication, you can directly file a writ petition before the High Court saying that this demand is incorrect.
Right, right, right. Okay, thank you. Okay. Next question is from Sankuni again. Why the file is not closed after the intimation of under section 143(1)? Is it for a chance for reopening?
No, why the file should be closed? Can't be closed because 143 intimation has been issued.
Right.
They have various avenues to reopen your case. 148, 143, 2.
Right.
They can do 263. Number of issues are there. So
Right.
just because a 143 intimation has been generated by the computer does not mean your income is correct and what you have disclosed is correct. They can still investigate.
Right. Okay. Okay. Next is from Jerome. After filing ITR1, received a notice under section 133(6).
Hmm.
Updated return was filed after withdrawing wrong claim of deductions. And also tax penalty was paid. Will there be any other penalty, etc. for this?
I don't
Do I
think
wait
so.
assessment order or show cause notice, etc.?
No, once you have done, once
Right.
you have showed or updated your income,
Mhm.
ideally there has to be a closure of the proceeding.
Also, the
But you
penalty is
can't
paid.
trust the system. Probably this might throw up in their inside portal.
Right.
And if it comes in their inside portal,
Mhm.
they are bound to issue 148 AB.
Okay.
But since you have an opportunity to reply to 148 AB show cause,
That
you
will
can
help.
point this out that this has been dropped, etc. I've paid tax, updated return, this, that, and therefore don't
Right.
proceed further.
Right. Right. So basically, this will have a red flag raised in their system, and that can
Yeah,
trigger
inside
it.
portal. There is a
Right. Right.
possibility. I'm not saying it will be done, but there is a possibility.
Right. Right.
And
And there is
as you know, as I point out, it is information driven.
right.
So there is
Right.
zero human interface.
Right.
If a flag is thrown, you can't exercise your discretion, say, no, I'm going to not reopen. You have to reopen. There's no option left.
Then we have to go with the flow.
Yes.
Okay. Okay. There is one more question from Nelson. Very important question. Can we get the copy of the presentation?
Of course, you can.
Okay, okay. There was actually one question from my end, but actually it got answered with your slide number 46 and 48. Basically, wherein the investments that were done in the assets were taken as an income, and it was taken above 50 lakhs, and the constant period of 3 years was breached, and they were able to issue a notice under section the reopening part. So that is allowed in a way they can do that.
They can do that, provided the investments are from undisclosed sources.
Right.
See, really, just because you are found to be owner of some investments does not mean there's an income escaping assessment.
Right.
There is a information which you have, but it is not suggesting income as escaped assessment. It has to be something more than mere investment.
Okay.
They have to form a belief, they have to issue show cause, they have to do inquiry and find out what is the source of investment.
Okay.
Because investment really is an outflow of
Right. Agree.
money, can't
Agree.
give rise to any income. Only if such investment is out of undisclosed sources, it gives rise to an income under 698, 698, etc.
Right.
So unless they come to a belief that it is out of undisclosed sources, you can't reopen. Just
Okay.
because there is a information that I have invested. That
Hmm.
can't be a belief or that can't be a suggestion that income is status.
Right.
And yeah, I think the tribunal judgments and there are high court judgments that merely because there are cash deposits in the bank account cannot be a belief, cannot give rise to a belief that income has escaped.
Okay.
There is a fantastic judgment by the former vice president of the tribunal, Pramod Kumar sir. Well, I think he was sitting in Delhi, Sir Bir Bahadur Singh, something of that sort.
Okay.
Judgment where he says that okay, there's a cash deposit, SSC has not filed income. That's okay. But
Mhm.
how do you say these cash deposits constitute income of the SSC?
Okay.
So there's a reason that you have a belief,
Hmm.
but that belief is not linked to the reason. There is no link or connection. Cash deposit, but cash deposit does not give rise to income. It may be from capital account. It may be something which is not chargeable
Exactly.
to tax. So you cannot link it with reason to believe. Therefore, reassessment is bad in law. That's a fantastic order.
And
Despite the
similarly,
fact SSC had not filed his return of income.
okay, that's important. Because similarly, exactly right you mentioned, there was one case wherein there was a reinvestment of FDs in an NRE account. That was also taken as like 60
Because
lakhs.
these are all information driven. They get
Yes.
information from banks, they get information from registrar of properties, they get
Right.
information from ROCs.
Right.
And they'll compare it with the return of income. They'll say, oh, no, you have not filed return. You have filed return of income showing 1 lakh income. You have filed return of income showing 2 lakh income. It's not
File
commensurate.
returns.
And they'll reopen.
Right, sir. Exactly. So if you can share that name of the case law, that will help, sir.
In respect of?
This High Court case law that you mentioned, wherein even if the income tax return is not filed, but
That's
they
not a
need to
High
have
Court case law. That's a case law of the Delhi Tribunal.
Delhi Tribunal, sorry. Okay.
And that you will find Sir Bir Bahadur Sijwali.
Okay, I'll note it. Okay, sir.
Okay.
So we are done with the question which were there. Okay, we are done with the question, sir. Dharan sir, thank you so much for your detailed insight on the topic.
Thank you.
And Dharanji, definitely we all have the reason to believe, and also the information shared by you suggest that the depth of the presentation has surely enhanced our understanding on the assessment reopening mechanism. It has also helped us strategize and for proactive compliances and risk management, insights into navigating assessment challenging effectively, awareness of the legal rights and avenues for the recourse. Thank you so much. The beauty of the practicing law, is getting into the detailed meaning and intention with which even a simple word is used. Again, sir.
Thank you so much.
Thank
My
you,
pleasure
Dharanji.
to speak at the ICI forum.
Yes, sir. Thank you so much. Again, thank you so much. I would also like to thank our chairman, Piyush Shajarji, and CA Vice Chairman, CA Kota Srinivaji for having this session, and also Singh sir for his presence in today's session. Thank you so much. Thank you, everyone. Namaste.
Thank you.